It's becoming a joke, housing in Canada. I used to be concerned, but now we're too far gone. I mean, it's getting to a point where only the upper class can afford housing in Canada. The government is trying to create programs to help the rising cost of housing, but come on man, let's be honest. 1.5 million for detached house in Vancouver or Toronto? One program's not gonna help a regular Canadian afford that. But you know what, since they introduced it, let's find a way to maximize its efficiency, giving you the best chance for a big down payment in the future. So what we're talking about is the First Home Savings Account, introduced by the government of Canada this year. And look, even though the housing prices in Canada are ridiculous, is that $4 million for this pile of shit? This is a good first step for those first-time home buyers. So what is the FHSA, First Home Savings Account? To put it simply, it's a registered account designed to get you to your first home. So to get into details, to be eligible for the FHSA, you have to be a first-time home buyer. Meaning in the current or the previous 4 years, you did not live in a principal residence that's owned by you, your spouse, or your common law partner. So if you live in a home that you own, you can't open an FHSA. If you opened an account before you got married, well then don't tell your spouse you have that account. Terrible joke, I know. For actual funny videos, check out my shorts. Long form's educational. Anyways, if you open an account before you got married and your spouse owns the house that you live in, you can keep using the FHSA, but you're just not a first-time home buyer. Meaning, you just can't use that account tax-free when you buy your next home. Unless, of course, you and your spouse sell the property and wait like 5 years. In which case, you'll be qualified as a first-time home buyer. So there's a lot of rules. But if you're a first-time home buyer, this account is a must-have. First of all, it's tax deductible. Kinda like RRSP, but what's different is that when you withdraw it, when it's used for your house payment, it's tax-free. You can contribute $8,000 a year until you contributed $40,000 in total. The account also has a maximum participation period of 15 years. I mean, I could get into more details, but there's so much more information you can find online already on how it works. So what I'm gonna do in this video is to tell you how to invest using your FHSA. To do this, we need to know how the account works. If you're looking to purchase your first home, you want to maximize your FHSA as soon as possible, even if it means sacrificing your TFSA. I know, that's shocking, and you want to try your best not to do it, but let me explain. How FHSA works is you get to contribute $8,000 a year. If you don't, it carries over to the next year. So for the next year, you can contribute another $8,000 for a total of $16,000. However, the maximum carryover is only $8,000. So let's say you don't contribute for 5 years. On year 5, you're still only allowed $16,000 in contributions. Which means on any given year, if you don't have $8,000 to contribute, you might want to consider withdrawing money for your TFSA because it's tax-free, and then putting that money into your FHSA. Because for TFSA, any money withdrawn can be added to your contribution room next year. Something FHSA can't do. Well then, why not transfer from RRSP then? Because RRSP doesn't work the same way as TFSA. Because once you transfer money out of RRSP, you don't gain extra contribution room next year. So if you're serious about buying a home in the future, you want to maximize your FHSA as soon as possible, even if that means sacrificing your TFSA. But as I said, that's the last resort. Try not to tap into your TFSA if possible. So the first step you want to do with your FHSA investing is to ask yourself, how far away are you from buying your first home? And you have to be honest with yourself. Cause if you're just starting out and you just graduated from college and your net worth is like $5,000, well, you're not getting a house for a while. Maybe 10 or 15 years down the line. In which case, your investment strategy should be different from somebody that's almost ready to purchase their first house. If you're young and you're like 10 to 15 years away from purchasing your first house, well in this case, you have time to be a little bit more risky with your investments. You want to invest in assets that historically generate a positive return, like the S&P 500, Dow Jones, or NASDAQ. But look at Tesla, why not invest that? You can, but it should be a small part of your portfolio. Again, you want to invest smart. Risky, but smart. You want this account to grow and hopefully outpace or at least keep up with the housing market without running into the risk of your account going completely broke because of bad investments. So then again, if you're young, just invest in like S&P 500 or something. Now, if you're looking to buy a house in the next 5 or 10 years, you want to tone down that risk level for your FHSA a little bit, because you might not have the time to ride through a bad recession. You might want 50% growth stocks like the S&P 500 and 50% guaranteed return investments. So GICs, for example. Wealth One Bank of Canada has a 1-year year or 18 months GIC for 6%. I would grab that. Essentially just tone down your risk a little bit. Now, if you're buying a house within the next 5 years, you want to be extra safe, because all it takes is one bad recession to completely wipe out your FHSA. You want to invest in short-term, high-interest rate GICs, or even consider putting that money inside high-interest savings account, essentially guaranteeing that your money is safe within the next 5 years. To conclude, if you're a first-time home buyer, the FHSA is a no-brainer. It gives you more purchasing power, because your deposits are tax deductible. Let's just say you're in the 25% tax bracket. By maximizing your FHSA that year for $8,000, you just increased your home purchasing power by $2,000. It's free money, so you want to maximize your contributions as soon as possible. And this includes sacrificing your TFSA if you need to, but do that as your last resort. Again, depending on when you think you can afford a house, you want to invest accordingly. 10 to 15 years, high risk level. So I decided to consistently gamble in an online casino. No, don't gamble. That was a joke. A bad one, I know. I guarantee you that my shorts are funny though, so check them out if you want to laugh. 5 to 10 years, medium risk level. Less than 5 years, as safe as possible. I mean, here's the thing, the housing prices in Canada is still super unaffordable. But now that the government gave us something to work with, you gotta use it. Alright, that's it for today. If you learned something from this video, consider a like as it helps the YouTube algorithm. And if you're kind enough, subscribe. I make financial tips for Canadians in my long form content and financial comedy in my shorts. Thank you all, and I'll see you next time.